Benzinga's pre-market prep. I'm Brianna Valesky here with Joel Elconin. We have Kevin Kelly on the line. Kevin focuses primarily on equities and options markets. He's the Chief Investment Officer at Recon Capital, where he oversees all research and investment strategies. He also serves as the portfolio manager for the DAX Germany ETF and NASDAQ 100 Call ETF. Kevin, how are you doing this morning? Thanks so much for joining us on the show.
I'm great. Thanks for having me. I'm really excited to be here.
We're excited to have you. I'd love to start with talking about some of these tech stocks, as I know you focus on those. Apple, of course, has had its Worldwide Developer Conference this week. Kind of an understated event. You know, some of their other events like the Apple Watch or any sort of iPhone unveiling people get really excited about, but this one hasn't really seemed to affect the stock at all. What's your long and short-term outlook for Apple right now?
So last time I came on Benzinga, we actually talked about the I bond trade, right? I mean, Apple was kind of stuck in a trading range between 124 and 127, and the recommendation at the time was to go out long term, go to January, sell a 120 put, right? Because the fundamentals are so good on the stock and they have performed well, but they're going to need that next catalyst to go to the next level, to get to the trillion-dollar valuation that everybody seems to have their eye on. And we're relatively in that same camp, right? I mean, there's nothing really game-changing. Apple iTunes already had a radio function on it. I had listened to it, so this was not anything earth-shattering to me. I think it was more of a publicity stunt, trying to get people to sign up for a streaming service. I think it could be a prelude into another content service, possibly where they do something with the television. So I think that's why there's a lot of rumors and speculation, because they do have to scale. So if they're purchasing content through one medium, they can leverage that to purchase content through another medium. But what really investors need to focus on is that Apple has had their refresh cycle already. So we know how that played out. We're not going to get the same iPhone numbers. So that's why we're relatively neutral to slightly bullish on the name. It's a great company, great leadership, great fundamentals, but there's going to be need to be another catalyst for the stock to move dramatically. So we're still in the camp that you could do another I bond trade where you sell some more downside puts, collecting that premium, and really go from there. Or you could do a risk reversal where you sell a put and buy a call just to have a bet to the upside.
That's a great point too, especially with the streaming music. I know there's so many other services out there. I'm pretty sure the Pandora CEO, after Apple made the announcement, tweeted out just okay when he heard about Apple doing its own streaming music service. Let's take a look at another tech stock here. I guess you could call it tech or automotive. What are your long and short-term outlook for Tesla right now? A little bit of analyst action earlier in the week, but other than that, it seems like Elon Musk has been relatively quiet about his company.
Yeah, he's I think reeling from everybody telling him not to comment on the stock. I think we're so used to him and Reed Hastings saying things about their stock
right.
So we've been programmed as investors, especially because they are cold stocks. But that's another thing. I mean, Tesla doesn't really trade on fundamentals. I mean, if you look at the price targets from analysts across the street, and now they're doing their battery factory in Nevada. So there's a lot happening behind the scenes, and it's hard to get a good grip on it, right? You're really investing in Elon Musk, who has been brilliant, but at the same time, you need to focus on your outlook on the overall markets and the U.S. markets, and especially a high beta name like this. So if you think we're going to be going into a slight contraction here going into the Fed making any moves, you should actually be very cautious on a highly levered name that is, Tesla. They've done very well. They make great cars. Again, think about the cars they make. They have great safety ratings. They're beautiful. That's why there's a cult following behind it. But there are some other names, if you're looking at the automotive sector, that you can get into. We prefer the German automobile manufacturers. I mean, last month's sales smashed all the American counterparts here in the U.S., and they're dominating overseas. So, we're we're cautious on Tesla, especially given where the market may be coming up in the next couple months.
Do you have a symbol for us for the German automakers there? I'm not really up on those. You talking about VW or what were you talking
Yeah,
about?
so they trade in ADR over here, so they're or OTC. So Daimler has one, Volkswagen as well as BMW. I can pull up the ticker symbols for you. So yeah, I can get those on over to you. I think it's ADDY. No, that's Adidas. So Daimler I know has
Okay.
over-the-counter stocks, but yeah, I'll send those on over to you
No
guys.
big deal. What about the U.S. autos? What about GM and Ford here? Ford has a little bit of a buying balance here, trying to clear the $15 level. That stock has been struggling here despite its strong market. What's your take on the Detroit motor companies?
Yeah, so that's a great question because we saw when the yen really weakened that the American companies, GM, Ford, really went on the defensive and was calling for Washington to have stronger currency policies because they are certainly affected by their overseas sales. I mean, that was the next growth engine for the American car manufacturers. It was all about overseas. So the problem is now that the euro's come down, now that the yen has come down, they're having this hard time breaking through 15 levels. I mean, they were hot stocks in 2009, 2010, and then they've really stalled out. We see that going into the future. I mean, the manufacturing prowess of Japanese manufacturers and German manufacturers. I mean, they make great products, and now they're cheaper overseas compared to their American counterparts, Ford and GM. Especially GM has a lot of overhangs, especially with their ignition switches. So we prefer Ford over GM in the sense that they don't have that overhang on the legalities. But, when it comes down to it, I think the technicals are speaking for themselves in the price action.
What about consolidation in the American automotive industry? Sergio Marchionne is trying to court Mary Barra at GM because he's interested in doing a merger between Fiat Chrysler and General Motors. I'm not sure if you follow the autos as much, but is that something
Yeah,
that you see in the future for the American automotive industry?
I think what they're trying to do at Fiat Chrysler is more of a defensive play because they are highly levered. So if you look at their balance sheet, it makes sense to them to get the economies of scale to deleverage themselves. I mean, I think that's why you're seeing him go around talk to activists, try to have them push GM to think about a deal. There are economies of scale, especially on the distribution side when it comes to the car manufacturers over here, but they are over levered. There's also the Ferrari IPO that they're trying to push out there. So Fiat Chrysler is trying to make a lot of moves. We see it as a way for them to really try to gain more market share, whether it's through a strategic partnership or it's through IPOing Ferrari.
Moving on to, you talked about Apple there a little bit, and you talked about selling puts and, options trading, whatnot. That's not really for everybody, right? Selling puts, you sell the 120 puts, you have to be comfortable if the stock has a 15, 20-point drop. Do you do that? Do you do that for yourself personally? You do that for a lot of your investors. There's definitely advantages of it because if it sits nowhere, if you sell a 120 put and it goes absolutely nowhere, you're making money on on an incremental basis. Just talk about that strategy a little bit, the pros and the cons.
Yeah, so options tend to get a bad rap sometimes because people you can use them because there is inherent leverage, right? So a strategy that we're talking about on selling puts is just like a covered call strategy, right? So if you have the cash secured, do you want to own Apple at $120? Are you comfortable, right? So if Apple's at 127 today, you're saying, would I own it at $120? If the answer is yes, then you may be interested in selling a cash secured put. So what that means is you have the cash available to buy each one of those shares for $120. So what it means is you are going to get compensated as well because you're giving someone the right to put it to you at $120. So they may give you $5 to do that. So that actually lowers your cost basis to about $115, and you're only doing it for a set period of time. So there's very conservative strategies that you can do, and the CBOE actually publishes several indices that are very cash sensitive, meaning you're not over leveraging yourself. They're very conservative. They're just completely transparent. One of them is the put writing strategy. So from 1998 to the end of 2014, it had lower volatility and better returns than the S&P 500. Same with their strategy, where if you own a covered call on the SPX index or on the S&P 500 and you sell a 2% out of the money call, that's outperformed all of the indices. So you can do conservative strategies and not use leverage.
Okay, let's talk about volatility here. It's been pretty lax, but then you get your spurts of it. We'll pull up the VIX here, the VIX here. I mean, it's a decaying instrument, just as it sits at itself. I mean, I think my partner, has mentioned that, the contracts are actually based to go to zero by, the expiration. I mean, how do you play this? I mean, what is your take on the recent volatility? Is it just a temporary thing, or is volatility here to stay?
So volatility is never going away. So there's volatility every single day in every single asset we have, right? So when we talk about selling calls or selling puts, that's an asset class of its own, because you're removing and stripping the volatility of something. So gold has volatility. So looking at this, where, vol is around 15, that's below the historical average, right? So historically speaking, over the last 20 years, volatility has been around 20. And so what we feel is that the Fed has actually muted volatility over the last couple of years. So what we've done is we've actually increased our long-term instability by decreasing short-term volatility through quantitative easing programs. So volatility is always going to be here. It's never going to go away. And it resets every day. So what the VIX does is it takes the volatility of the S&P 500 going out the next 30 days. That's all it does. So tomorrow, it's going to take the 30 days going from then. And then the day after, it's going to take the 30 days going from then. That's why you see it reset every single day. So it's just an indicator of 1 month out. And we know that June is historically the second most volatile month, right? And what we know is October and September tend to be more volatile as well. That's why in the options market, we're seeing bets going on in September, and that has to do with the Fed rate hike as well. So right now there's some increased volatility. It happens to do because it's a historically volatile month. But, we're below averages. The Fed still has interest rates at a low rate. So we don't think volatility should scare anybody. They should embrace it and use it to their advantage.
Volatility, though, don't you kind of associate that with downside action?
A lot of people do. It tends to get that indication of the fear index. So yes, a lot of people do associate it with downside action because it does spike up, because what it does is price in a lot of contracts, especially on the put side. So yes, it can indicate lower markets. But as we saw back in middle of 2009, volatility was high and the markets just kept rising and rising and rising and rising and rising. So it doesn't necessarily indicate lower markets. What it does indicate is that there is going to be bigger swings.
All right, and for the Fed, I mean, that the utilities, some of the interest rate sensitive stocks, the REITs, are they just demanding that the Fed do something here in September?
Yeah, I think everybody's demanding the Fed do something in September, especially myself, because I think everybody's sick and tired of talking about when the Fed's going to be doing liftoff. Right now, we're seeing the Fed funds futures market showing at the end of 2016 interest rates being below 1%. So we can see in the markets, they're really pricing the Fed's not going to be doing much, especially out to the end of next year. So it's important for the Fed to do something. And what we think could be beneficial is if they do something that they've never done before, and that's just do rate hikes at 10 basis points. Do it slow, do it gradual. That's what a lot of people are thinking is going to happen, because we don't want the Fed to spook the markets or send mixed signals by raising rates and then pausing, and then raising rates and then pausing, and then taking rates down. So if they do it at a 10 basis point level, it won't really spook anybody, especially in those interest rate sensitive sectors that you're speaking about, where, real estate, utilities, but the overall market will be pleased the Fed is actually going to take action and get off this zero interest rate policy.
I mean, even if you go at the rate that you're talking about, an incremental basis, I mean, aren't you much better off than in some of these higher paying dividend stocks? I mean, do you ever think you're going to see, 3-4% interest rate, Fed funds rate, or, T bills or CDs at those levels again?
No, it's really hard to see that, and especially because if we look out to 2018, the average baby boomer is turning 65, and that's when the federal government has 55 trillion of unfunded liabilities hitting the balance sheet. So, it's hard to see interest rates above 3 or 4%, especially in the near future, before 2020. And so when you're talking about those dividend stocks, all you really need to know about stocks is that markets can still rise meaningfully provided that earnings are going to rise. And that's really it. So if we look at a lot of the names that are paying these dividends, do we think they're going to rise meaningfully because of the earnings that they produce? And they are showing, we look at that last earnings quarter this previously. The names that really dragged it down was the energy stocks, and that's because obviously oil came down. Otherwise, a bunch of other stocks were only impacted by currency fluctuations, but they still had meaningful earnings. So we think, if they're a stable company and they're making earnings are rising meaningfully, whether that's even through stock buybacks, then, there's no reason for them to go down.
Kevin, we've got about 2 minutes left with you here. I want to take a step back and just get your overall global market outlook right now. What are you seeing globally?
So globally, we're seeing a lot of outperformance coming from over in Europe. And so there's two great markets over there. Germany is one of them. They've got 30% of the GDP. The United Kingdom is another great one. The United Kingdom actually, if you look at the FTSE 100 index, it produces 3.7% yield. And it's trading at a 17 times PE currently, and the forward's about 15. And it's strong names like HSBC, Arm Holdings, GlaxoSmithKline, Royal Dutch Shell, BP, Diageo. So if you drink Kettle One, Guinness, Johnny Walker. So there's great names over there. You can get the yield. They've got 2.5% GDP growth. It's outperforming the U.S. market, and their bond market actually isn't volatile like the German market and like the U.S. market right now. So we think there's an opportunity over there. There are several ETFs that track the United Kingdom, the FTSE 100. So they're out there. You can look at them. You can get the yield, and it's kind of a retreat because their election cycle is over. Ours is coming up next year, so there's going to be uncertainty in our market. They've just reelected David Cameron. We think there's opportunity over there.
We've been on the line with Kevin Kelly. He's Chief Investment Officer at Recon Capital, talking about volatility, the markets, Apple. Great coverage, Kevin. We really appreciate it, and we hope to have you on again soon.
Thanks for having me. Have a great day.